Welcome everyone to Macroeconomics exercise class, session number 1 on GDP and price indices. Today we would cover systems of national accounts, nominal and real GDP, and we would wrap up our discussion with price indices. Problem number 1 in session 1 is systems of national accounts. 1.1 is GDP calculation. Here you are given a country which is a closed economy. It doesn't have imports and exports, or to say it doesn't have any international trade. And it has 3 industries: iron ore industry, steel industry, and car industry. These industries, they have their own wage structure and production structure. The iron ore industry pays a wage of 75 euros, and the iron ore industry produces iron ore to sell it to the steel industry. The value of this iron ore is 140 euros. The steel industry, which buys the iron ore from the iron ore industry, produces steel and ships this steel to the car industry for 250 euros. The steel industry would pay a wage of 50 euros. The car industry, after buying the steel from the steel industry, it would produce cars, and it would sell the cars to the government for 140 euros and to the consumers for 360 euros. In the car industry, we have also a wage structure of 125 euros. So your task is to calculate GDP by summing up the values of final goods, by summing up value added, by summing up different components of aggregate demand, and by summing up incomes. To do so, we need a table which I would draw. First, we would have list of industries on the left hand side. And we would have production first, followed by intermediate products, and followed by value added, which can be calculated by the formula production minus intermediate products. In the last 2 columns, we would have wage income and capital income. So after constructing this table, we would be able to calculate GDP using the 3 approaches that are already defined. The first industry, as we have said, is the iron ore industry. And we have seen that they produce iron ore for a value of 140 euros. And the iron ore industry doesn't have any input, so we consider 0 for intermediate products. Value added, as I have said, is the difference between production and intermediate product. So this is to say 140 minus 0, which would give us 140 euros. The wage in the iron ore industry is defined to be 75 euros, and the capital income in our case is the difference between value added and the wage income. which is 65 euros. So the capital income is an income which is secured by the investors or consumers when they are having some shares which pay dividend. The second industry is a steel industry. In the steel industry, we have said we have a production of 250 euros worth steel, and they take an input from the iron ore industry, as we have seen here in the iron ore case, for a value of 140 euros. Similarly, the value added would be 250 minus 140, which would give us a value of 110. We have said in the steel industry wages are equal to 50, and then we take the difference between value added and wage income, which is 110 minus 50, which would give us 60 euros as a value of capital income. The final industry is cars industry, and we have seen here that cars are sold to the government for 140 euros and to the consumers for 360 euros. When we add these two together, it would give us 500 euros, which is the total production in the cars industry. We have seen here in the steel industry that they produce 250 euros worth steel, and they shipped that to the cars industry, which should be considered as an intermediate product for our cars industry. Again, for value added, we take the difference between 500 and 250, the difference between production and intermediate product, which would give us 250 euros. And we have already mentioned that the wage in the cars industry is 125 euros. We take the difference between 250 and 125 to reach at 125, which would be the capital income in the cars industry. So once we set up this table, we would calculate GDP by first the production approach. The production approach has two items. The first one is, I would indicate it by 1A, so calculating GDP by sum of values of final goods. Here you should remember that the only final good produced in the economy is car, and car is produced for a total value of 500, which is to say cars are sold to the government with 140 euros, to the consumers for 360 euros. Adding this would give you a value of 500, which is again the GDP of the economy. The second approach in the production approach, or the second item, is calculation of GDP by using sum of values added. We have seen in our table that the value added in the iron ore company is 140 euros. The value added in the steel company is 110 euros. The value added in the cars industry is 250 euros. So if you add these three numbers together, you would come up with a value of 500 euros, which is again a representative of the total amount of our GDP. The second approach that we want to calculate GDP with is called usage approach. So in the usage approach, you might remember again, cars are sold to the government for 140 euros and to the consumer for 360 euros. In the usage approach, we have to make a formula, we have to make use of a formula which says GDP is equal to C, which represents consumption, plus I, which represents investment, plus G, which represents government expenditure, and plus, in theoretical sense, export minus import, which is the net export. So in our case, as we have said, consumers are buying cars for a value of 360, so this is to be considered as consumption. And in our economy, we have said that there was no investment, or there was no information given regarding investment, so this should be indicated as 0. G represents the government expenditure. As we have already said, governments buy cars for a value of 140 euros, so we would indicate 140 for government expenditure. Since we have said it's a closed economy without any international trade, without export, without import, we don't have any net export item here, so we would indicate it to be 0. And finally, this would give us again 500 euros, which should be considered as the final amount of the GDP in our economy. The third approach that we are going to consider right now is the income approach. So if you remember from our table in the beginning, we have seen two types of incomes. The first one is wage income, and the second one is capital income. So we would take the sum of the wage income first, which would give us 75 in the iron ore industry, plus 50 in the steel industry, and 125 in the cars industry, giving us a total amount of 450 euros. The second income that we have seen is capital income, and the aggregate capital income is 65 euros in the iron ore industry, 60 euros in the steels industry, and 125 in the cars industry, which gives us again a value of 250 euros. So GDP with the income approach is the aggregate of wage income plus capital income. This is again to say 250 plus 250, giving us 500 as a total value of our GDP. So as we have seen, within the three approaches, we are having a similar value of 500 euros for our GDP.